Hello, everybody. Thank you all for joining. This is not a fear-mongering type of video or title. Let me see if I got fear-mongering. I do. Good. But there's just some things that are just quite insane. And I listened to the Jerome Powell press conference live, watched all the data, and put together the story. I was going to put it together anyway at some moment in time, but this is about the disconnect between what they say and what's actually happening behind the scenes. And I'm going to show probably the most depressing slide I've ever shown in my entire life on slide 5. So watch out for that. So let's just jump in. Thank you to the mods in the chat. Thank you for Pancake Panda as well. And, you know, when people see there's no other option, as someone noticed in the chat there was also a little tiny pump in Bitcoin, which is good. It's up $300 since the few minutes I've been here. Anyway, big day. The T, appreciate you. We put all these stickers to really good work, and everybody makes a difference. So thank you so much. So this is kind of the disconnect that could cost us all. I share stuff that's important for us to be aware of to protect our future. And today, even though a lot of the data I'm going to show that back up my points is US centric, the same thing is happening all over the world. It's not unique to the US. So let's jump in. This doesn't really matter today. So let's talk about some numbers. Let's, as you know, I like to always try to find patterns in numbers. And if you look at this, what do you see? Big thank you to Sanjay for sharing. Mr. Hammer, I see you out there. Hope all is well. This is from Joe C by way of Sanjay. And you can see here, in between the bank failures and everything that has happened over the last 2 months, the Fed jacked rates into a banking financial crisis. I mean, yeah, I'm not the only one that's been talking about this for a long time, but it's kind of funny, and we're seeing some funny words as well, like driving blind and other stuff. Never have we gone up so far, so fast, first of all. Second of all, if you look at this chart, this takes us back to what happened before the global financial crisis. Every single macro chart I pull up, I see GFC all over again. I've been doing this for not videos, but looking at charts for more than 3 decades. And I'm wondering, I'm just a guy on the internet. Is nobody else seeing this stuff? In addition, and those of you who are around since the dot-com bomb, I lived through that. It was a very dark time. We're going back 23, 24 years. And we see the exact same thing. The 3-month Treasury bill rate is the same as it was back in the dot-com bomb. Then they had to cut to bring the economy back. Again, more patterns, more numbers. 2 of the nastiest recessions we're seeing, absolute interest rate similarities, which is so strange, so bizarre. Let's talk about this slide. This one will shock you all, and it's confirmed by the Bureau of Labor Statistics. And this is part of the disconnect that the Fed does not get. Okay, so I'm just going to pop this up and walk you guys through it. And again, the most depressing slide I've ever shared. According to the Bureau of Labor Statistics, the Consumer Price Index, etc., for all urban customers between 2010 and 2023, or even 2020, no matter where you look at it, your money has a half-life of 10.47 years. I'll talk more about that in a minute. This means that the cost of goods and services has increased, has doubled. So as a result, if you were earning, let's just talk about it, go back to 2010 for a second. Back in 2010, 43 million families earned $50,000 or less. Today, 50 million, not today, in 2020, 50 million US families earn $50,000 or less. So the point is that if you had $50,000 in 2010, that would be like having, $50,000 in 2010 is like having $100,000 today. But look at those numbers. I mean, this is just so mind-blowing, and it's probably confusing. I'm looking at this and say, how is this even possible? But 50 grand in 2023 has the same purchasing power as $100,000 in 2010, or vice versa. It is shocking. And this is the problem. This is why the Fed says, oh, labor market's fine. No problems. But look at this. The half-life, first of all, of the US dollar is 10.47 years. Been proven time and time again. That shows you 100 grand, $100,000 10 years ago is like 50K today, etc., etc. You get the idea. But people aren't earning more. They're earning a lot less. And that is the real issue. And that's the problem we see in the market today. Now, JP, Jerome Powell, head of the Fed, said live in a conference, wage growth should equal productivity growth plus inflation. So I ran and I crunched some numbers real quick, hey, KB Robin, and you can see here, this is the source. You can pull this all yourself, drop it into a spreadsheet, create a little chart, takes a minute. This is from the current population survey. Again, data from the Bureau of Labor Statistics, the Federal Reserve, Bank of Atlanta calculations, etc. It is the actual indexing of salaries since, the 90s. But you can see there has been a bit of a spike, and this is why they're sticky. But even at that, is it keeping up with the current level of expenses? No, it's not at all. So let's look at this chart again. He said, wage growth should equal productivity and growth plus inflation. That's bullshit. Okay, I hate to use a bad word. Sorry out there. I just got... Anyway, productivity has gone up since the 50s, or 1948, 240%. While hourly compensation has only gone up 109%. And this is the problem. So no, salaries are not keeping track with the actual loss of purchasing power out there because of the half-life of money. And this is why we talk about things like Bitcoin a lot in this channel and everything else. But hang on, we're just getting into the story. It's about to get a lot worse. So the Fed is concerned about the wage spiral. This little peak here, you can see going up to 6%. But when you look at the real cost of living, it's a lot higher. Just look at the house prices over the last 10 years. Look at the cost of apples over the last 10 years. Everything is going kind of crazy, and you get far less for your dollar than you did back then. So the conundrum that they have is, yes, the wage price spiral is alive and well, but it's not keeping up with productivity and inflation, not by any stretch of the imagination. This is a chronic situation. I feel like I'm rapping here or something. The Fed do not control inflation for the 100th time. They destroy demand, and that's the problem. All the data they're looking at is wrong, and a lot of smart people have said that very recently as well. So let's switch gears. We'll talk about regional banks. This is kind of one of the many concerns I have. And there is good news at the end, so hold tight, everybody. But here, this is the destruction of regional banks and the impact on the economy. The regional banks are banks who lend to small businesses. Regional banks lost deposits, and now they can no longer lend. Small businesses can no longer have access to credit. And the market has not seen the impact of this yet. It is yet to hit. And therefore, I do believe we're going to see a credit crunch from a very dark place hitting soon. No credit means no ability to run a business. Credit situation is far worse than the asset liability mismatch situation that we had before. I recently myself, I know at the time I had a little bit of a credit crunch to pay some taxes. And I doubt First Republic, my bank at the time, was going to give me any money. Anyway, we have not even seen the start of this credit crunch coming. The credit cycle, the liquidity crunch, whatever you want to call it, is going to be nasty. And that's going to have a huge impact on the economy. In addition, the banking situation, this is two funny words here. Some people call it idiosyncratic, all the bank failures, the big three of the four biggest bank failures in the history of the United States all happened in the space of 8 weeks. But are they idiosyncratic? Of course not. They're all related. As like the transitory word that they used in the past. And deposit instability continues to be a real issue. The deposits continue to drain from the small banks and all flow into one big bank. We'll talk about them in a minute too. In addition, for those of you in the real estate market, I know some of you out there in the chat are, commercial real estate is already at risk. Many ask, what to touch, etc. But here, small banks, regional banks, etc., account for 70% of all commercial real estate loans outstanding. That is massive. How are they going to lend? They don't have any deposits to back up their lending. Plus, when the commercial real estate rolls into a much higher rate, to the tune of 7, 8, 9, 10%, depending on how shaky the ground is that the business is on, because of all the additional expenses like increasing wages, etc., it's going to be really, really hard. And that's going to put a huge dampener on commercial real estate. There are buildings in San Francisco that are 80% off right now from what they were selling for 2.5, 3 years ago. And that is a stunning change in a short window of time. In addition, there are other industries that are going to be hit with all of this. Real estate, well, obviously when interest rates go up, it becomes more expensive to borrow to buy a home. and this can lead to a slowdown in the housing market. We're seeing that, but in select areas, some markets are actually up. And I'm watching them carefully. Some of them are getting completely smashed. So we always say follow where the people are going. Those markets are red hot. Think Austin, Texas, and others. Automotive. When interest rates go up, it becomes more expensive to finance a car loan. And this can lead to a slowdown in the auto market. Yes, Ford has something like a year and a half or 6 months of inventory on their lots for trucks and stuff. They can't move the metal, as they say. Consumer discretionary. When interest rates go up, it's more expensive for consumers to borrow. Things like furniture, electronics, vacations. That is already seeing a big slowdown right now. And we saw data out of Sweden. Retail spending fell 13%. Like that, fell like a rock. It's never happened in the history of the world in Sweden. And that's probably a canary in the mine for the rest of Europe right now. Technology. When interest rates go up, the more expensive it is for companies to borrow money to invest in new products, and this results in a slowdown in the technology sector. We're seeing that too. Look at the AMD semiconductor earnings, because people aren't buying computers. That's an example where the consumer discretionary and technology are linked at the hip. And finally, financials. When interest rates go up, banks make more money on loans, but not if they have no deposits, and they also have to pay more to borrow from other banks. And again, this leads to the whole credit crunch. So it's just, there's more industries than that, but this is just the top 5 that are really, really hit right now and expect some damage. And the Fed say people are willing to work for under $50,000. Jobs exist as far as the eye can see. The reason for that is people don't want those jobs, because when a family is earning only $50,000 a year, they cannot make ends meet. And that is a problem. That's why when the Fed looks at jobs, JOLTS, postings, and openings, companies would hire all day long if they can hire people under 50K. But the problem is people can't work for that level of money and survive, so they don't take the jobs. Does the Fed know that? No. I don't know why. It's madness. And of course, I shared this beautiful picture yesterday. Is the Fed responsible for breaking banks? The sword hitting the piggy bank nose, cracking the porcelain? Yes, they are still trying to kill inflation, but of course we know they don't control inflation. So let's go a little bit further. Let's talk about the Fed fiscal policy. So they've increased the rates. They took it up another 25 basis points today. The deficit is already going to be greater than 10% of GDP. That may not sound like a lot, but 10% of everything that the US makes and many other economies around the world is a deficit. It's like a tax. And what happens next? Well, when you have a situation like that, the government needs to borrow more money, which also, because of the amount of debt that the government has, this can drive up interest rates that they have to pay on that money. This makes it more expensive also for businesses to borrow money, and it can slow down, and it will slow down economic growth. We see that. And higher inflation, when the government spends more money than it takes in, it leads to inflation. It means they have to print money to pay for the deficit, and reduced confidence in the government can also result in higher interest rates they need to pay on their debt, and on and on and on. And this results in one big increased risk of a financial crisis. We have a crazy exploding deficit right now that is just alarming people. And the deficit this year already is on track for being more than $2 trillion, probably 2.5, 2.4 at least, by my calculations. In addition, money printing is also required because of the regional banking crisis. The FDIC has thrown shareholders under the bus. Regulators do not want the public to perceive their actions as bailouts after what happened in 2008. Remember what was created as a result of 2008? Begins with B, everybody? Yes. And it's clear that they want large banks to keep getting larger because the FDIC has no more money. Right now, I show this twice because it's stunning. The top 15 banks in the United States have 75% of US deposits. The other 4,000 banks have 25%. And that 75% will go to 90% soon, where the big 10, big 5 will own pretty much everything. And that is why many people suspect it's going to be part of the Great Reset as we're going to go forward. This is the FDIC. In addition to it becoming more expensive to insure banks and bank deposits, it will eat up 14% of bank earnings. And they're already having enough stress with the asset liability mismatch, the hold to duration problem, the lack of deposits. it's just, we've only just begun. Or, if it was a tennis match, what would it be? The first game and the first set? A long way to go. There's probably a baseball analogy too, but I don't really understand baseball. Let's talk about who is winning this game. And it's clear that they want the large banks to keep getting larger. And that's why JP Morgan was allowed to bend some rules and jump in and grab First Republic after throwing all the shareholders under the bus. And this option is perceived as safer, but this is a short-term viewpoint. And our system will soon be controlled by just a few banks. Again, as I mentioned before in statistics, this is scary. No more lending without very strict requirements, full control. And this paints a very ugly picture for the world as we go forward. Very little competition. We all know how that goes. Now, let's enter Stanley Druckenmiller. Stanley Druckenmiller warned... Did I say Druckenmiller? Druckenmiller, he's got a hard name, warned the US debt crisis is worse than he imagined. He is a top investor, hedge fund investor, and he said the debt ceiling impasse is dwarfed by the dangers of unchecked government spending and future government spending, adding that the Fed is fueling this reckless behavior. He said it's like watching a horror movie unfold. And meanwhile, averting a default may come down to 7 days. By the way, that 7 days is the length of time President Biden and the House and the Senate members are going to be in Washington between today, which is the 3rd of May, and the 1st of June. There are 7 days to negotiate out of this mess, and it's ugly. So we've got just pretty much everything is going wrong. But let's see. Let's look at deficits. This is the deficit driving the debt spiral. That red stuff, doesn't matter who the president is, it keeps going down deeper and deeper and deeper. Revenues are shrinking, especially as GDP shrinks, especially as things like markets don't do well. They didn't do very well in 2022. So tax revenue is going to be a tiny slither, and the deficit is going to explode. It's going to have one of the highest deficits on record very soon. And that little red kind of tidal wave is going to get bigger and bigger. And there's no escaping this. And now everybody's beginning to talk about it and see it. Again, once you go beyond, I think, 70% debt to GDP, it's going over it. And now we face the fact that the GDP is shrinking and the debt is going up. That means the debt to GDP ratio could very easily hit 140%, which is insane. I never thought I'd ever see that in my lifetime. Now, there is also, this is kind of a motivation for this video from the Kobeissi letter. Again, thank you to Sanjay for sharing it with me. The disconnect between the Fed and reality is alarming. The Fed statement, U.S. banking system is sound. U.S. Treasury, U.S. banking system is on a solid foundation. And the FDIC, U.S. banking system remains resilient. What are these people looking at? Over $1 trillion deposits have left the small regional banks, community banks, etc. Regional bank sector is down 40% this year. $2 trillion market cap disappeared. Literally, poof, gone. The amount of losses by shareholders is through the roof. People aren't happy. You've got people that were shorting things like First Republic in Robinhood, and the stock was halted. They weren't even allowed to collect on their puts. I mean, the stuff that's going on is very, very shady, to say the least. How can these three units say these three things with a straight face? I don't know. And this is why the disconnect between the Fed and reality is completely alarming. And that's why I've been thinking for quite some time, there's a bigger game at play here. And it's not something that we should know about or understand, because then we'd all freak out. In addition, the bond market says the Fed went way too far. Look at this, 184 basis points, the spread between the 3-month and the 10-year bond. Again, we're looking at history here. Thank you, MT. Never seen anything like this in the history of our lives. This is insanity. And then the bond market normally tells the truth, and they're saying, everywhere you look, any chart you look at, you see an alarm bell kind of flame situation burning down. But there is a bit of good news, and there's more good news coming. So it's not the end of the world, everybody. So one way to think about the Fed's decision, I always try put my feet in their shoes, as it were. And this is the real interest rate. And the real interest rate is the nominal interest rate minus the inflation rate. And when the real interest rate is positive, it means that savers are earning more money on their investments than they're losing to inflation. Of course, the inflation number is cooked, it's not real. But again, the positive thing here is when you look at this chart from Zero Hedge, real rates are typically only positive less than 20% of the time. And this tells me, and many people believe too, they are pausing. No more hikes. But there is a lot of damage that's going to still happen because of the hikes that have happened already. Remember the 6-month lag between hiking a rate and seeing the actual impact of that hike. Now let's talk about the good news. It's important to have some good news. Hey, Paul, thank you. This is the CME futures of the rate forecast. So first of all, we'll be talking about kind of the potential of a cut before, say, September, October, some type of time frame. Now, according to the CME futures, they believe as early as the 14th of June, which is only 5 weeks away, we could already have our first cut, but it's only an 8.2% chance. The pause, 78% chance of that, and a 13% chance of a hike. So, when you bounce all that out, it looks like with a high degree of certainty, the pause is in place, which is good. Now, there's even better news too. When we dig up a little bit of history and we look at what happens after the date of the last hike. So if this is the last interest rate hike, recent market history going back to 1984, and I won't tell you how old I was back then, but recent market history shows that equities have generally rallied in the months following the end of the past Fed tightening cycle. Tightening cycle. Oh my God, I need more coffee. In the 3 months following the Fed peak funds rate, S&P returned on average 9%, ranging from 14% to the high to minus 1%, and rising in 5 of 6 episodes, which is not bad. And you can see the return there. I put a little red box around this chart showing you the 3-month return is 9%, 6-month 12%, and 12-month 19%. So on that 12-month basis, that is pretty stunning. And we only had one nasty time, and that was May 2000. But again, we spoke about that already. That was the dot-com bust. That's when markets went to levels that were never, ever seen before. Hey, Stephen, good to see you, buddy. Let's talk about a little bit of bad news, though. I did promise good news, but this is the impact of hikes. And just a little isolated situation to make you aware that things that you may depend on may not be there when it comes time to collect. And obviously we know remote work is causing corporate landlords to struggle. I talked about the commercial real estate crisis. They can't fill offices in select cities. This is leading to real estate investors panicking. And the situation is worsened by higher rates, eroding fundamentals, and a very unfavorable macro environment. We know unemployment is going to rise. The Fed have told us that. Even the Fed told us we're going into a recession. This is not going to be good for CRE, commercial real estate. And there's $1.5 trillion in CRE debt that needs to be refinanced before the end of 2025. That's 2 years and change away. And we will have to do it at much higher rates than what they typically are financed at today. And this has led to one pension scheme called the Californian State Teachers Retirement System preparing to write down a portion of their $51 billion real estate portfolio. They believe investing in real estate is the safe way to go, but nearly a quarter of the teachers' pension funds are in this, and they're going to get hammered, as well as some of the other stuff. Private equity, it's way too risky to be playing with. Yes, the returns can be high, etc. What else do they have in their bag here? Large private equity, real estate management. Yeah, it's all ugly. And risky stocks too, you could imagine, but at least they have some Tesla, which could be good. Maybe that could save their bacon, as they say, as they go forward. So the point I'm trying to make here is hiking interest rates impacts everything as we go forward all over the world. And we saw pension crisis in the United Kingdom, Germany, and other places. So what does the US look like right now? Well, this is the kind of the US economy, although we don't see it yet, but it'll look like this in very short order. We're already seeing stores shut down, people going in wholesale, looting, just grabbing whatever they want off the shelves, and people are just upset and unhappy, and the economy is not supportive. So quick summary, this is a very ugly chart, but I'm trying to kind of summarize all the stuff we just spoke about today. So the Fed jacks rates on the labor market. The Fed look at the labor market. The Fed don't understand the labor market is structurally different. There has been no influx of foreign workers because of C-19 and restrictions and all that type of stuff. And nobody wants to work for 50K. And then we had the Great Resignation and the quiet quitting. This has impacted the whole labor market. But again, the statistics do not show this. Then you have liquidity. The banks are not hedged for interest rate risk. They have the asset liability mismatch. The bank runs for the small regional and community banks can't hold on to deposits. Business credit's going to dry up. That means small, medium-sized, even some large businesses could fail, and the economy will be destroyed, and unemployment will shoot up. And this is painting a very grim picture. And then the impact as well. The government deficits are exploding. Consumer stops spending. For example, the Swedish example I mentioned. The commercial real estate disaster is looming, and car makers will lose billions. That's why, this guy, love him or hate him, I know more than half the people in the world hate him, but Elon Musk said the Fed is making decisions using stale data. It's like driving a car while looking out the rear window. I always say looking out the window of the car to keep an eye on the kind of the macro. And it's fine when the road is straight, but it's destined to crash when the road is winding, and we are going into a windy road. And the Fed data has way too much latency, etc., etc. We've seen the canary in the coal mine, which is Silicon Valley Bank and First Republic, etc. And one of the staunchest miners, Credit Suisse, died too. The cemetery is filling up fast. Further rate hikes will trigger a severe recession. Mark my words, per Elon Musk. Top capital allocator on earth. And that's why he's been cutting prices in his cars, because he doesn't want to be caught out with cars in the lot. He wants to scale them up, but that's going to impact the other ICE manufacturers. So the point is, what can you do? And literally, I've painted a picture, a pretty desperate picture around how the half-life of the dollar is 10.47 years, how a $50,000 salary today is like having a $25,000 salary 10 years ago. That's the reality. And the only thing you could do, any type of safety blanket, is get into something that is super hard, that will not debase like a fiat dollar. And that's why I always say all roads lead to Bitcoin, everybody. So thank you all for being here. Sorry, it was a bit of a sad story today. But my job is to report the news, and so you guys can all prepare. And we'll see. Yes, and SAS Finance, the world does need more Elon Musks right now. He is exposing all the crazy stuff that's happening in the world. Again, love him or hate him. We'll see. So cheers to all. Good to see you out there, Kiwi, Zeno, Jack Russell. I was bitten by a Jack Russell once. That's funny. But thank you all for being here. Happier story tomorrow, I promise. And smash the likes on the way out. And thank you as well to the mods too. Now we try find. Oh, wow. Bitcoin went up even more. But it looks like it's facing a bit of resistance at that 29,000 level. Now I don't know where my controls are to turn this thing off. There we are. Thanks all. Have a good night. And hope you enjoyed Fed Day. But things are kind of alarming. See you.